Paul, did you learn anything in the last minute and a half?
Well, remember, what these are is just an update on estimates about the second quarter. So the original numbers were pretty good. We had it right before. They're not necessarily an indication about what's happening if we look forward. And I think that's the real divide right now. The consumers may be looking at wage growth, employment, looking back and saying, this is really pretty good. We can afford to spend. But on the other hand, when you start to look forward, you've got all of this talk about the inversion of the yield curve and a lot of angst about whether things are getting worse. So there's this real tension between the backward-looking and the forward-looking perspectives.
Well, and let's just amplify that or continue with it. You also have manufacturing PMIs rolling over without a doubt. You've got capital investment, capital X trailing off. Apparently, there are a lot of things that would indicate maybe it will sooner or later end up with the consumer. Can the consumer keep going despite all those indications, and for how long?
Consumer sentiment is a very fickle thing, and some of the data that you just mentioned, in particular manufacturing data, the average consumer doesn't really know about that yet. And I think it's going to take a little bit more time for that to really bake through and affect whether or not they're going to spend. One of the things, and I mentioned this earlier, when we came into this year, the rally was really built on the predication that we were going to have a strong labor market and that strong labor market would persist. That continues to be the case. And if I'm a consumer and we have a strong labor market and I feel like either I'm going to keep my job and get a raise or I have the opportunity to get another job for more money, I'll continue to spend. Until that starts to break down, I think consumer sentiment stays okay, barring any big headline risk. I mean, we saw earlier in the year a government shutdown affects it pretty negatively as well.
So, Paul, I think everyone agrees consumer sentiment is terribly important for this economy. At the same time, we are getting some mixed signals. We had the University of Michigan numbers come out. They really had trailed off. Then we had the Conference Board come out, and they were quite strong. I'll put a chart up because Stephen Stanley actually wrote an interesting note saying when there's a divergence between the consumer sentiment numbers on those two indicators, it's not necessarily a good thing. Basically, what this is the purple line is the difference between Conference Board and UMich, and the yellow line is the 210 spread. That basically indicates there's some correlation apparently here, because University of Michigan might be ahead of Conference Board. Should that give us some cause for concern that maybe the consumer is getting softer?
Right. That these two measures of consumer confidence may pick up more of the backward-looking perspective or a little bit more of the forward-looking perspective. And the consumers aren't going to directly experience the yield curve inversion, but they're going to pick up noise about it. And so I think that may already be giving a little bit of concern. And if you go back to this exchange of Dudley, I think one of the reasons that he's trying to send a signal that a fight between the president and the Fed could be damaging, that fight is something that's going to get attention by consumers. And so I think both parties need to kind of be clear that that's dangerous and stand down.